All right. It's almost the top of the hour. All right. 6 p.m. Central Standard Time. It is now time for our first of what will be, I promise you, many Third Thursdays. So, if you are new to our channel, then this is going to be something we do every month, every third Thursday, where we answer financial literacy news topics you need to be aware of. We cover things on social media that you may have seen and want to know whether it's true, fake, a valuable strategy, or one that's valuable to other people but not just the right timing for you. So, to introduce myself for those who are unaware, my name is Brenton Harrison. I am a financial advisor by trade. I am the founder of New Money, New Problems. We are a virtual financial advisory firm, although I am located in Nashville, Tennessee, and we serve the needs of first and second generation high income earners, not first and second generation wealthy people. We focus our firm's efforts on serving those who are not yet wealthy, but have more income than they or their parents have ever seen before. And they're trying to navigate some of the new problems that come with it. So, if you like this third Thursday, I encourage you to check out the rest of the page that we have. We post videos every single day on valuable topics, not just the things that you submit. But if you're watching tonight and you have some questions, by all means, we have some topics that we're going to cover to make sure we're not talking about nothing and wasting your time, but we also have the option for you to put some questions in the chat and let us know if there's information that you want to hear. While we wait for some people to log in, we've been promoting this on socials and the like. I would say that there are a couple of events that we have coming up beyond Third Thursday that you might find interesting. On next Friday, February 27th, we are holding our Black with Equity webinar. We have a lot of people in our community who have equity compensation at their job that's offered to them whether or not they take advantage of it. That could be in the form of restricted stock. It could be in the form of an employee stock purchase program, stock options, be they incentive or non-qualified stock options. And it can lead to a lot of confusion. And every single year, this is a big portion of our planning where we walk people through the processes of making sure that it's a tool that you use to leverage your wealth in a positive way, as compared to leveraging it or having it be leveraged against you and leading to an unexpected tax bill. So next Friday, February 27th, 11 a.m. Central Standard Time, we are going to hold a webinar where we tell you a lot of things that you need to know to integrate equity compensation into a strong financial portfolio. If you want to register for that webinar, you can go to newmoneynewproblems.com/black equity. That's again newmoneynewproblems.com/black equity, and you can register, send it to a friend. You don't have to be Black to attend, but it's something that we want to do to finish off Black History Month with a bang. So, third Thursdays, what are some of the things that we're going to talk about tonight? It is tax time. So around tax season, we always make sure that we give you some valuable information that you need to know about what it means to file your taxes, how to do so in a way where you can take advantage of deductions and credits that are valuable to you in a legal and compliant way. And as a financial advisor who's not a tax professional, we also speak from the lens of someone who wants to make sure that you're using your taxes to benefit your wealth, your investments, to save on your taxes from your investments and the like. So we go about it in that lens. Now, when we share some of the videos that we're going to share tonight, I want to first give you a reminder of how taxes are calculated in the first place. And this is something that we do on the New Money, New Problems podcast very regularly. You start with the amount of income that you earn from all sources. That is literally your total income, not the income you pay taxes on, but your total income. That could be everything from the salary that you earn at your job. It could be interest income from a bank account, which counts as income when you're totaling up your income. It could be dividend income from a brokerage account in which you've invested. Depending on a divorce and when you were divorced, it could be alimony if you were divorced before a certain period of time. All of those things can potentially count as income sources. That's your total income. The next thing that you do after you have your total income is you lower the income on which you pay taxes by taking advantage of something called above the line tax deductions. And above the line tax deductions are things that anybody can use regardless of their tax circumstance. And they are things like the amount that you contribute to your pre tax retirement account at your employer, a 401k, a 403b. Every dollar that you put into that type of tool, it reduces the income on which you pay taxes by that same dollar. So if you earn $100,000 and you put $5,000 into a pre-tax 401k, you're only going to pay taxes on $95,000. Some other common above the line tax deductions is the money that you put into a health savings account, a flex spending account, a dependent flex spending account. If you're an entrepreneur, you pay more in employment taxes than everyone else who's not an entrepreneur. So you actually get to take an above the line tax deduction for half of your self employment taxes. So all those above the line deductions, they take the total income that you earned and they use it to reduce the income on which you pay taxes. After you've utilized all those above the line tax deductions, you're now at your adjusted gross income. And adjusted gross income is a huge term across many different levels of your finances. If you have federal student loans, adjusted gross income is what they use to actually calculate the payment that you make if you're on an income driven repayment plan. So it's very important to understand that, because if you can lower your adjusted gross income, you can lower your federal student loan payment. Adjusted gross income is also something where if you have too high of an adjusted gross income, it can subject you to other taxes that other taxpayers don't have to pay at lower incomes. For example, if you have an adjusted gross income above a certain amount, you have to pay more taxes on investment income. You might not be able to participate in certain accounts like a Roth IRA and things of that nature. So, adjusted gross income is a really important tool. So, you have your total income, you reduce your income on which you pay taxes using above the line deductions. You then, after you've reached your adjusted gross income, you make the decision on whether you're going to itemize your taxes, which means there's all these other deductions that you have at your disposal, and you're going to total up those deductions on your own, or you can choose to take the standard deduction that's available to all taxpayers. So, for example, you might go from 100,000 down to 90,000. Then you make a decision of whether you have your own deductions, which means you're itemizing it, and maybe that brings you down to 70,000. If not, you would choose to take the standard deduction, meaning I'm not going to take advantage of any of those itemized. I'm just going to take the standard that they give me. And after you've taken either one of those, you've reached your actual taxable income. Now, I give you that primer because when you watch a lot of videos about how to avoid taxes, there is a lot of confusion when it comes to what's legal, what's not legal, what works, what doesn't work. And I want to make sure you understand the difference between tax avoidance, which is you trying to minimize what you pay taxes on, and tax evasion, which is when you're doing something that's potentially fraudulent to avoid paying taxes. And when it comes to what you can do and what you can't do, when you see videos like the one I'm about to share, it can be very confusing to make sense of what they are talking about. So we're going to queue up one of these first videos so you can get a feel for some of the things that we see online every single day. And this first one is about where you file your taxes.
If you have anything other than the most basic financial situation, like one job, maybe you pay rent, you have no investments, you have no Roth, no retirement account, then it'll be free. But if you have even one of those things, I swear the price jumps to like $150 and it is not worth it. My recommendation is to use freetaxusa.com instead. It is absolutely free, $0 to file your federal taxes and $16 to file your state. It will still take you through the step by step process that you would see on TurboTax. You're like, oh, this makes it so easy. It does the exact same thing. Gather all your documents, log in, and fill it out. I've been doing it now for probably 4 years, and I love it so much. I actually love doing my taxes. That sounds crazy, but I'm being so serious.
She is talking about. When it comes to federal taxes and filing them, there's a lot of different systems that people will use. You can have a CPA file your taxes on your behalf. You can use TurboTax, which I would say, in terms of marketing, is the most popular service that people use. And a lot of people like TurboTax because it walks you through a lot of different prompts that guide you in terms of how much you actually pay. So it says, hey, go find your W 2s from last year, read box one and input the information that you see in box one here. Put the information for box two there, and it's very intuitive. So people like it because if you don't want to have to pay a lot of money for a CPA, TurboTax seems like a really intuitive way to file on your own. And when you have something that's dominated the marketing game in terms of public awareness, it's very easy to think that they're the only platform out there that has kind of solved the process of making it easy to file taxes on your own. Now, I'm a person who thinks that the more complicated your tax filing is, the more likely it is that you need to work with a professional. But the fact of the matter is, there are people out there who self file. And if you look at TurboTax in particular, the marketing does not exactly match up with the reality of what's available in terms of other tax filing systems. The tax filing platform that the person was talking about in that video is called Free Tax USA. And it is one of the certified or official partners that the IRS has partnered with for their free tax filings. There's a lot of people based on the income that they earn in this country who are legally allowed to file their federal taxes at no cost. And the IRS has a number of partners that they have joined in agreements with where they are certified partners for the free file system. Interestingly enough, TurboTax is not one of those official partners, but there are several others in addition to the site that she shared, where if you're looking at it and you're saying, hey, I might go to TurboTax, and yes, it seems intuitive, but when I put in all my information, they tell me it's going to be $150 to file or $200 to file. TurboTax has actually gotten in a lot of trouble for misleading people in the past about their free filing and who actually has to pay. There's all these other different platforms that you can use that are right on the IRS website as official partners that are equally as intuitive. Now, you might have one platform that you enjoy more than others, but worst comes to worst, when you look at just what's going on, it's something where you don't have to just flee to TurboTax because everyone told you, hey, I use TurboTax to file my taxes. There's a number, of other systems out there that are just as easy to work through and might be a good fit for your tax filing. Now, to me, when you start to get into the process of going to a TurboTax and the charge keeps going up, right? It's like, hey, they told me it was free. Now it's $150. Now it's $500. That's because of the complexity of your return. And there are some scenarios where just not even just because of the potential missteps, I would say because of the potential missed opportunities, that alone is a sign that you should potentially reach out to a professional preparer. For example, I'm an entrepreneur, I'm a homeowner, I'm married, I have a child. That child is below the age of 13, and we have expenses that are related to that child so that my wife and I can work. So, right off the bat, I know that instead of just having a basic 1040, I'm also going to have a Schedule C because I'm a homeowner. I am a person of faith and I give to charitable organizations, I give to my religious institution. So that means that I have to make a decision every year of whether I'm going to take the standard deduction, but I can also itemize and total up all of the things that I could use for itemized deductions, things like the interest that I pay on my mortgage each year, things like my property taxes, things like in the state of Tennessee, the sales tax that we pay. For my child, I know that there's going to be child and dependent care expenses for the cost that we pay for things like summer camp so that my wife and I can work while he's, needing to be entertained during the day. And each of those things is a separate schedule, a separate filing, is something that adds to the complexity of return, and it's something that can be missed. For example, if I'm talking to someone and they don't realize that since their child is under the age of 13, that they have certain costs that might be eligible, for example, potentially the amount that you pay for before care for that child or after care while they're waiting for you to pick them up before you get off work, that's something that could be potentially deductible. It's not something that you might be aware of if you don't follow the right prompts on a self-service system. But when working with a tax professional, they may prompt you for certain things. There's also certain things that a tax professional may pick up on when reviewing your return that even a financial advisor picks up on that you need to be aware of. For example, we talked about the fact that when you have an adjusted gross income above certain amounts, it leads to additional taxes in a way that it doesn't generate for other people. One of those additional taxes is something called the net investment income tax. And what it means is if you have investment income, in addition to the regular taxes that are owed on that income, you owe 3.8% on top of that in additional an additional net investment income tax. Why is that important? Well, a financial advisor, a tax professional, they may look at some of the interest that you earn from things like bank accounts. They may look at some of the interest that you earn for dividend income and things of that nature for things like a non qualified investment account. And they may say, hey, let me take a look at the structure of your investments to see if there's a more tax efficient way to make this work. One example might be for many people with whom we work, they have their money in high yield savings accounts. And it's great to have your money in a high yield savings account. You want to make sure that you're getting some rate of return on your money that's sitting there above and beyond what you get in a traditional savings account. However, if we have people who have significant reserves and they have not touched those reserves, don't plan to touch those reserves, every dollar of interest that's generated by that bank account, that high yield savings account, is not just being taxed at their ordinary income rate, which might be 24%, 32%, 35%. They're also paying 3.8% on top of that in net investment income tax. In some of those scenarios, what we have done is we've encouraged those people to look into things like municipal bonds that may not be taxable at the federal level. So now, even if you're getting a lower return on the municipal bond, when you factor in that one of those things is taxable, the other is not, they're actually getting higher yield because of that net investment income tax. So those are some things that you see that can be picked up on when you have a professional filing your return. Whereas if you're filing something on your own, yes, you may get that return filed. But when you're talking about a comprehensive financial strategy, it's something where uh, you're not getting as much juice out of the squeeze because of your lack of a professional in the room. Now, we're going to pull up another video when it comes to taxes that gets into that line I was talking about of like tax avoidance versus tax evasion and understanding where you're really getting a benefit. Because in this scenario, I feel like there's somebody who has gotten a little bit of information and has kind of deployed it in a way that is not quite accurate. And as soon as I can get this video loaded, we're going to share it with you. All right. Bear with me. You're dealing with an older person and an older computer. So as I clunk around and try to get this video up, as a reminder, if you have questions, feel free and type them in the chat. But we have this video up now. We're going to share it.
They throw me in jail or take all my stuff? No, you're not going to go to jail and they're not going to take your stuff. And I'm going to show you why. It's called tax avoidance. And there's 3 super effective ways to do it. So
before we even get into that, we talked about tax avoidance versus tax evasion. Tax avoidance is technically legal. It's using all of the tools at your disposal, be it a tax deduction, a tax credit, to essentially either lower the income on which you pay taxes to as little as possible, or once you have calculated the taxes, to use things like credits to lower the actual taxes owed to as low as possible. In some cases, $0, although there's a concept called alternative minimum tax that makes that less likely for high income earners. But conceptually, so far, the term tax avoidance is a legal term, but let's keep going.
the whole idea is to reduce your taxable income to as low as possible. You've gone exempt on your W-2 or your W-4, or if you're a 1099, you decided, I'm just going to stop paying taxes and not file at the
Yeah, that you can't do that. So you can't just decide that you're not going to pay taxes and not file at the end of the year. I mean, you can do it, but it's not going to work out very well for you. When you talk about a W-4 is the form that you fill out, you submit to your employer, and based on the form that you fill out is how your employer estimates how much tax to withhold from your paycheck and send to, at minimum, the federal government. If you live in a state that has state taxes as well, it's the federal and state governments. And what happens is at the end of the year, there's essentially a true up. So, for example, let's say on the federal level, you had $20,000 of taxes withheld from your paycheck. And when they calculate your taxes, it turns out that you only owed 15,000. That's why people get a tax refund. If it turns out that you had $20,000 withheld and you owe 25, then you owe $5,000. And that's when people get into a tax situation that could be problematic. When it's a 1099, that means that somebody is working for themselves and they are responsible for paying quarterlies, right? So unless they are in a scenario where they're like an S corp and they are taking care of some of that through payroll distributions, essentially instead of a W-4, you're having to file quarterly taxes to take care of an estimate of what you might owe. But the whole process is a bit of a crapshoot, right? You're projecting throughout the year what you think you're going to earn and what you think you're going to owe in taxes. And at the end of the year, they're going to figure out whether you were right or wrong, whether you were over or under. And that factors into whether you get a refund, whether you owe, or whether you're right on the money.
End of the year. How do I keep from owing the IRS a shite ton of money at the end of the year? First, bestie, you're going to calculate how much money is taxable out of your income. You can use the IRS website's income tax estimator or an estimator of your own. Then you're going to try to invest all of that taxable income into tax deductible accounts.
Well, much easier said than done to invest all of your taxable money into tax deductible accounts. That's basically saying, hey, if I have $50,000, just invest $50,000 into a tax deductible account. Not only is that very difficult for most, from a cash flow perspective, but there are limits to what you can put in many tax deductible tools that just make that an impossibility. So, for example, she's going to talk about IRAs. You can't just put $50,000 into an IRA, but let's let her keep going and I'll walk you through some of the other complexities.
Deductible 401k or a traditional or Roth IRA.
So she said some of the options that you can use to lower your income on which you pay taxes, a tax deductible 401k, absolutely. But she also said a Roth IRA or Roth 401k that actually would not meet the mark of avoiding taxes. And with an IRA, it's important, even with tax avoidance versus tax evasion, to give you the difference between like deferring taxes for another time, right? Like you don't just not pay taxes at any point when you put money into any of these. It's just a matter of when you pay taxes. With a pre-tax 401k, you're putting money into an account before it's taxed. That's what's used to lower the income on which you pay taxes. And you don't have to pay taxes while it grows, but in retirement, when you take out those funds, you pay income on it as withdrawn. So for example, if you put $5,000 into your account this year, you don't pay taxes on that $5,000. But if it grows to $500,000 30 years from now, and in the first year of your retirement, you withdraw $25,000, you're going to pay income taxes on $25,000 of income in that year. So you're not doing away with taxes. You're really just kicking the can in that scenario. But a pre-tax 401k is something that does allow you, at least in this year, to quote unquote avoid taxes. The next part that she said about Roth accounts is not correct because a Roth account works in reverse. The same thing we just talked about, you just flip it on its head. With Roth accounts, you put money aside that has already been taxed in exchange for that money growing and growing and growing. And when you withdraw it in retirement, you pay no taxes on the funds that you withdraw. So in her scenario, where in 2026, she's trying to avoid paying taxes, putting money into a Roth account actually wouldn't help at all.
Both of which you can actually find socially and environmentally responsible companies to invest in. If you want to learn how to invest into an IRA or a 401k socially and environmentally responsible, check the link below. You can invest up to $7,000 a year into tax-deductible retirement accounts. That's a
You can actually, in certain retirement accounts, put way more than $7,000. She's talking about an individual retirement account. There are accounts like 401ks. I think this year the limit is $24,500 just for an employee contribution. There's after-tax contributions that you can make that go all the way up into the $69,000, $70,000 range. If you have a simplified employee pension IRA as an entrepreneur, you can do up to 25% of your income up to a certain limit. So $7,000, and this is actually a good correction. There are many scenarios where you can put a substantially larger amount than that aside in these accounts.
A lot of money you're not going to owe the government. Number 2, health savings account. A health savings account is a tax-advantaged account that allows you to save for high-deductible health plans or medical emergencies. And it's pre-taxed money, so the government can't tax whatever you contribute to it. And my personal favorite, donating to tax-deductible charities. You can find many comprehensive lists of tax-deductible charities online and start investing some of your taxable income to help others.
So this is why I gave you the pretext of above the line tax deductions, below the line tax deductions, itemized versus the standard, because the third option that she gave is to contribute money to a tax deductible or a tax exempt charity, and you can use that to avoid taxes of your own in the year 2026. To be clear, that's a very morally sound recommendation. It's not the most tax sound recommendation in terms of how the structure works for many people. We've talked about this in recent episodes, but starting in the year 2026, if you choose to take the standard deduction, then you can claim up to $2,000 of charitable contributions on your tax return. So if you make a $3,000 contribution across various charities and religious organizations, you're going to be capped at that $2,000 if you take the standard deduction. So that actually means that you can't always avoid taxes just by submitting it to a charity, because if you give that money to a charity, you could be in a scenario where you have exceeded the allowable amount that you can take for that new deduction in 2026. Conversely, for people who choose to itemize their deductions, this is something that they now have a new barrier that they have to cross in terms of what they can deduct, because starting in 2026, there's now a 0.5% threshold that they have to clear before they can claim charitable deductions. So for example, if you make $100,000, you actually can't deduct every dollar you donate to a charity. Even if you itemize, you have to clear a $500 hurdle, that being 0.5% of $100,000, and only the amounts exceeding the threshold are eligible for that deduction. So again, good in theory, not exactly something you can use in practice, but if you have some strategy attached to your taxes and you're working with a professional, it's something where you can do some optimizing to make sure you can take as much of an advantage as you can based on what she's sharing.
You can tax strike and keep yourself relatively safe doing so. We don't want to fund Trump and ICE anymore. If you want to participate, check the links in my bio and join our Discord.
So, who, if you watch the podcast, if you are just, watch the YouTube channel, listen to the podcast, it's pretty clear where I land politically without me having to just blast it. This may sound like a bit of a surprise based on that clarity. I think that it is very rare that you'll find like a corporate partner of a certain size that hasn't done something that you would consider morally compromised, right? Like I remember when people were telling me that I could no longer shop at Target. And to be clear, I have no problem with anybody who chooses to not shop at Target. But the alternative they were telling me was to go to Walmart or to go to Amazon. And to me, it's like, you can't be serious, right? But all of those organizations have done something that someone can find fault with. And I'm not someone who's telling you to not look for environmentally or socially responsible organizations. I will say that in some cases, it's a bit more complex to make sure that your money is clear of those moral concerns than what people describe. So for example, in the video, she talks about finding ESG companies that you can invest in. And she talks about how easy it is to find. And that's not always the case, right? You have to, if you look at a 401k, choose from the available investment options that are provided by your employer. And it is rare, I wouldn't say rare, let me take that back. You will not always find that an employer will offer environmentally or socially responsible funds inside of a 401k. And you will be likely to find that the option they push you to is something called a target date fund. A target date fund is something that picks the year closest to the age you want to be when you retire. And the further you are away from that year, and invest the funds more aggressively. And the closer you get to that year, that investment becomes, I want to progressively more conservative sounds odd, but it becomes more conservative the closer you get to those target dates. Now, the thing about those funds is most of them by this point in time are mutual funds that are tracking large portions of the market. So they might have some international stocks, some domestic stocks, a little bit of this, a little bit of that. And you don't have the ability as an individual participant of that plan of going into that mutual fund and cherry picking companies that you don't want to invest in. So you would have to decide to just not invest in your 401k or to invest knowing that somewhere in this account, especially when you get to large employers, there's likely a company or two or 10 that I wouldn't exactly be pleased to be associated with. But unfortunately, just because of how interlinked our economy is when it comes to employment, when it comes to the Department of Labor, when it comes to just the larger companies that run this country, it's just a hard thing to like extricate yourself from. So to me, if you want to in your individual accounts where you have more control, go the extra step of saying, hey, I want to be environmentally safe. I want to be socially responsible. You can do that by owning individual stocks and doing a hell of a lot of research in those companies if it's something that interests you. But I don't want you to feel discouraged. I also don't want you to feel like you, are suddenly not invested in these companies because you think that you've done everything that you can and you find out later down the line that some company is highly invested in your company 401k in a way that you simply can't do away with. The other thing she's talking about is a tax strike. She's not really describing a tax strike. She's saying tax strike, but she's really just giving you tips and tools, some of them valid, some of them, not necessarily ones that everybody can use to reduce the income on which you pay taxes, which is a valid objective. But to me, it's one of those things where just understand what you're actually doing. In many cases, when she says tax avoidance, she's really talking about just deferring taxes so that you pay them at another point in time. In the case of things like your 401k or your IRA. In other scenarios, she's really just talking about using tools like above the line tax deductions to reduce the income on which you pay taxes, tax credits to reduce the taxes themselves, but it's not some like hidden form of the tax code. It's just something that you are likely just kicking the can and making a decision of when you want to pay. Now, we've done a lot of tax talk. I do want to pull up a video that we were sent about investing, right? I know that you didn't come to a YouTube live to just talk about taxes. And as a financial advisor, we have kind of these different camps of people that we talk with. And it's very rare that we meet someone in the middle, right? It's either someone who has a really complex financial picture and they've kind of graduated from entry-level financial advisors is not the phrase that I want to use, but they've graduated from basic financial advice on budgeting. And now they're in a scenario where they do need someone who is truly integrating some investment knowledge, some tax knowledge, some insurance knowledge, some estate planning knowledge, and they want us to kind of fill in the gaps. The other camp of people that we deal with very regularly are people who are trying to get started. And I have a passion for both, right? But to me, when I have someone who's trying to get started, one of the quickest questions, or I should say the most consistent questions that we get is, how do I start investing, right? Most people don't come to an investment advisor or financial advisor and say, how do I pay down my credit card debt? Although I do get a lot of people asking about student loans. We get more people asking me at a dinner party, what stock are you invested in right now? And I'll tell them, like, that's not my bag. I'm not a person who, keeps up the stock reports and has two screens up monitoring each individual company. I'm more someone who believes in long-term diversification, buy and hold. But a consistent question that I get, a consistent question that you see online is, I'm interested in investing. Where should I start? And because that's a consistent question, there's a lot of financial media, financial videos out there that kind of give you an idea on content like, where should I invest my first $1,000? So you have all of these different content creators who have their version of where should I invest my first $1,000. I'm going to share one of these videos. I'm going to tell you kind of my perspective on it. It doesn't make it right or wrong. It's just my opinion. And I'll give you my ideas on a person who is getting started investing and where they should focus their efforts. This is another case where this video is taking forever to load. So while it is taking forever to load, I'll say again, if you have any questions that you want us to cover, feel free to type them in the chat. And as soon as this gets loaded up, looks like that's working now. We are going to share this screen. Give me 1 second. All right.
So this is how I would invest my first $1,000 in 2026. My name's Steve. I'm a former public school teacher and I grew my account by more than $200,000 in 2025. My first $400 would go into an ETF that tracks the S&P 500 like SPYM, SPY, VOO, or IVV.
All right, let's start right there with what is an exchange traded fund? What is the S&P 500? Is this something that you should invest in if it's your first $1,000? So an exchange traded fund, we talked about mutual funds and 401ks, and a mutual fund is just a collection or a basket of different stocks or bonds. So you might have a basket that has 50 different stocks, 20 different fixed income instruments. They put them all together, and based on the risk of that portfolio, they tilt towards one way or the other, and you are investing in the entire basket. So you're not investing in each individual company, you're investing in the basket. And as that allocation of companies grows or loses money, you're kind of growing along with them. The thing about a mutual fund is oftentimes you have like individuals who are managing that fund for you. And as is the case with anything in life, people want to get paid for their work. You also have mutual fund companies that will market that fund to other people. And believe it or not, they charge you a fee called a 12B1 fee so that they can afford to go market their fund to potential new customers. So there can be some high expense mutual funds that can kind of turn people away from the mutual fund strategy because of how much it's costing to invest. And as a result, it led at some point in time to the creation of exchange traded funds. So exchange traded funds, they offer a portion of the market. So in this case, they're tracking the S&P 500, which I'll share what that is in a second. And there's several differences with an exchange traded fund as compared to a mutual fund. First, because it's likely that they're just tracking a portion of the market instead of a huge team of individuals managing the investment, you're paying less internal expenses to have an exchange traded fund. So you might have a mutual fund that has an internal cost ratio of 0.65, and you might have an exchange traded fund that has a similar level of aggression and is charging you 0.15, right? So less than a fifth, right? So there's a big difference. Another difference between mutual funds and exchange traded funds is with a mutual fund, you can put in an amount that you want to contribute, or you can put in a request to sell that fund, but they don't do intraday transactions with mutual funds. So for example, if I want to put money into a mutual fund at 11 a.m. on a Friday, that order is not going to get filled until the price has settled for that mutual fund at the end of the trading day. It's not something where I can sell it during the day, buy into it during the day. I have to wait until the market is closed. And as a result, you can sometimes miss opportunities, or conceptually, you can miss opportunities because of that structure. Exchange traded funds, they can be structured in terms of what's in that fund the exact same way as a mutual fund, but you can trade them throughout the day while the market is open. Hence the name exchange traded funds. So there are a lot of people, because of their tax flexibility, there's less turnover in these funds than mutual funds, which can lead to less taxes if it's a non-qualified account. In terms of their internal expense ratio, in terms of just the flexibility and the long-term diversification, they prefer an exchange traded fund to a mutual fund. Now, what is an S&P 500 exchange traded fund? The S&P 500 is a collection of essentially the 500 most cash-rich companies on the US stock market. So these are your Nvidias, these are your Metas, these are your Apples, your Amazons, and essentially those 500 most cash-rich companies, they comprise the S&P 500. So I say US companies because if you understand that and you want some international exposure, you're not getting that with the S&P 500. It's all domestic stocks. But there are plenty of people out there, people like Warren Buffett, who say, if you want to invest, don't pay anybody, don't worry about anything. All you have to do is put your money in the S&P 500 and just let it do what it does. Now, I actually appreciate the fact that this person in front of you looking on screen, they have on the screen kind of a pie chart, at least at this point in time, of what stocks are actually driving the performance of the S&P 500. And this is an important point because it's going to drive home my feelings about it being the first place that people should invest. The S&P 500, it makes it sound like if you put $500 into the S&P 500, that they're investing $1 in each of those companies. But that's not actually how it works. The S&P 500 is a weighted index, and the weight is distributed based on how cash rich those companies are, what level of market capitalization they have in the stock marketplace. So what that means is because some of these companies are just infinitely bigger than others, you could have 5 or 6 companies in the S&P 500 that are actually driving the majority of the performance of that index. So for example, at this point in time, Nvidia is sitting here with 20.4% weight. Apple, 7.3%. So now we're at 27, 34% if you include Amazon, 39% if you include Alphabet, 44% if you include Meta. And what you'll find is if you look at the top 25 companies in the S&P 500, they are driving probably 70 to 80%, if not more, of the performance of this exchange. So while you are investing technically in 500 companies, you really, in terms of what's driving the performance, are investing in a couple dozen, if even that, companies that are overwhelmingly responsible for their return. Why is this a problem in some scenarios? Well, the first, ethically, there are people who, when you look at some of these companies, they may feel like, oh, if I were choosing my own stocks, I wouldn't want to be invested in Amazon as an example, or maybe they don't want to invest in Meta. Well, if you invest in the S&P 500, unless you use a tool called direct indexing, which is a conversation for another day, that's not possible. The S&P 500, if it's in the S&P, you're investing in that company. The other reason this can be a concern is if I'm investing my first $1,000 and I'm pretty aggressive, this is not a problem for me, right? Like I believe in these companies long term. I'm okay with the fact that they're going to rise and fall in a somewhat volatile fashion. I'm in this for the long run, and I'm not going to pay much attention to the day-to-day performance of this account. But let's say that I'm a person who is deathly afraid of the stock market. And I have been avoiding putting money in the market for a very long time. And if I put my money in the market and it doesn't go well, I'm going to be so put off by this that it may be another 5 years before I try this again. I don't know that I would take that person and put them in a portfolio where 80% of that account's performance is heavily dependent on the returns of companies that are all kind of in the same sector. So if this person needs things to go well, and all of a sudden these companies, many of which are interlinked when it comes to things like AI and different corporate contracts, that portion of the market doesn't do well, I could be looking at really wild swings that, while over time may benefit me if I buy and hold and don't pay attention to what comes in the interim, may make me very uncomfortable watching those returns day to day. So the assumption that people should just put their first $1,000 in the S&P 500 no matter what is, to me, a dangerous one, because it doesn't consider factors like risk tolerance and how aggressive or conservative that consumer may be, because there may be something that doesn't have the same boom potential as the S&P 500, but is a better entryway into the market for this particular investor.
This allows me to invest in the top 500 companies in the United States like Nvidia, Apple, Amazon, and Google. Next, I would invest $300 into a growth or technology ETF like QQQM, QQQ, VUG, or VGT.
So they're saying they're going to essentially double down, right? They said they wanted to put it into a tech ETF. And we just talked about the fact that if you look at the S&P 500, overwhelmingly, the companies driving that exchange are already tech companies anyways. So this person is essentially saying, number one, like the amounts that they're saying are very arbitrary, right? Oh, I should put $300 here, $200. Why? Why not just put $1,000 here? Why put $900 here? But they're taking the $200. They're saying essentially, let's double down on this strategy of betting on tech stocks and bet in ones that are even more volatile than the ones that you might find in the S&P 500.
Next, I would invest $200 into a high dividend paying ETF like SCHD, VYM, or SPYD.
So what is a dividend? A dividend is excess profits. So you can have a fund and there are managers of that fund. You can have a stock. and you can have a company that has excess profits during the year. And if you don't want people selling your stock or you don't want people selling your fund, but they need to raise cash, well, one way that you can provide them their cash without them selling the investment is to give them some of those excess profits. And the way that they do that is by issuing a dividend. Now, a dividend is something where it's like, hey, it's money that you don't have to work to earn, right? You just have to have the investment in and of itself. But not everyone needs stocks that pay a high dividend. I told you that we work with people who earn a significant income. And when you earn a significant income and you just not only generate the taxes that come with selling stocks, buying stocks, and having a capital gain, if you have dividend income as well, if it's an ordinary dividend, that's taxed just like the money that you make at your job. So someone who's in the 32% tax bracket, if they're getting dividend income, they're paying 32 cents on the dollar for the highest portion of their income. But they also, depending on that, could owe net investment income tax. So they're paying an additional 3.8%. So for every dollar in dividend income that they earned, it's generating 35.8% in taxes. And if that's not something that you actually need for your portfolio, there may be other ways to achieve a similar objective that's taxed in a different way. We talked earlier in this episode about a municipal bond. If I have a 3.8% dividend and I am paying 35% in taxes, give me a second to pull up a calculator. Well, that means that even though I got 3.8%, when I factor in taxes, my return was actually 2.47% because I only kept 65% of the return in this scenario. I might be able to find a municipal bond that's generating 3%. And even though 3.8 is higher than 3, the fact that that municipal bond is not taxable means that my after-tax return is actually higher. So this is a scenario where, again, is the concept of a dividend a good idea? Yes. Does it mean that it's the right idea for everyone? No, because there could be some investors out there who can find a similar or better after-tax return by looking at a different tax advantage feature, than a stock that pays a high dividend.
I personally invest in SCHD and the dividend yield is currently 3.8%, which means that I get paid around $1.05 per share per year. Next, I would keep $100 in a money market fund with high interest. There are a lot of great ones out there, but the one that I personally use is SPAXX from Fidelity. If you want to start investing but don't know how to start, you can join my next beginners investing workshop today and tomorrow. Comment invest and I'll send you a link.
This gets to something that I actually talked about. We're going to be on, or I should say, I'm going to be on the Rich and Regular podcast sometime. So we recorded it a couple weeks ago. Really excited about that releasing. But the thing about that podcast that we covered is we talked about like the way that people give financial advice online. And I actually think this is something that it's like a shared responsibility between the financial literacy content creator and the person who is digesting the advice. What I mean by a shared responsibility is this person is obviously selling a service or they are sponsored and they are trying to get more sponsorship revenue by having more people tune into their channel. They clearly have done well. And in pursuit of them getting more people to their cause, they're sharing information about how they've done so well. I have no problem with that. To me, where I encourage people, and it's not even a disrespect to this person, I encourage people to lean more towards education and like teaching a person how to fish than saying, this is the fish, right? Like, this is where you go, this is what you do, this is what you buy. To me, it is far more instructive to tell someone, here's what I look for in a company in which I invest. It doesn't have to be this company. Here's an example, and here's why I chose this company. I prefer that than saying, here's what you should buy, right? Because it takes away the context of what that person actually needs, what else is going on with their portfolio, what's going on with their risk tolerance, right? You know nothing about this person and you're telling them exactly what you use without saying, hey, but you should consider what's going on in your personal situation. Now, here's the thing. Where does that responsibility lie? Does that person have to tell you that every single video? Of course not. It would make no sense at all for a person who chooses individual stocks to cut off themselves at the knees and say, I like this stock, but before you buy this stock, think about the fact that you may not have 3 to 6 months of income set aside in reserves. You may still have credit card debt that you need to consider. It's not their responsibility to do that every single video. It's a shared responsibility of the person watching the video to understand that there are more simple steps that they can take to build a foundation, like building 3 to 6 months of reserves, like putting money in the market, but having it be in something that's a little less risk or less volatile that fits their needs and objectives and where they are financially. So to me, when you're consuming financial advice, I would encourage you to watch videos like that with a grain of salt, not because what the person is saying is wrong or because they're lying, but because it may not be the fit or provide the context that you need to integrate it into your own portfolio. So those are some of the things that I think of when I look at investment advice. It is very rare that I find somebody who is interested in putting money into the market who comes and is doing it for the first time and in my opinion needs to go to single stocks or needs to say, oh, it has to be this or has to be that. In many cases, even when we're talking about things like the S&P 500, I want you to do things like take a risk tolerance questionnaire to figure out how aggressive or conservative you might be. And some of that is not just dictated by what you want to do. Some of it is dictated by the rest of your finances. I have people who will come and they'll just be a month into their savings or a couple of months savings, and they'll start a non-qualified brokerage account and they're investing in the riskiest stocks and positions that a person can find, as compared to saying, hey, I'm not yet in a position to actually be able to lose money. And you always have the possibility of losing with the stock market. But I would be more inclined to have that person say, let's start slow. I'm dipping my toe into the market. And even if I want to be aggressive, I'll be able to be more aggressive once I've built a larger reserve for myself. And that speaks to finances in general. We're rounding up, unless you all have some questions for the evening, with the end of our first third Thursday. And to me, whether it's taxes, whether it's investment advice, whether it's insurance advice, I would encourage you to go the extra step of asking questions, not just about like the legitimacy of the advice, but ask the question of how does this factor into my financial picture, right? If someone's telling me something to do with taxes, tell them a little bit more about your scenario. Ask them how that applies to you before you take that advice, which may be fringe advice, it may be good advice that's just not relevant to you, and implement it into your strategy. When it comes to investment advice, you should be even more careful. Again, not necessarily because the person is saying something that's inaccurate, but they may be saying something that's accurate and relevant to them that is either not relevant to you because of your risk tolerance, because of your long-term goals, or based on your income, because of your tax situation. And following that advice without asking more questions can be something that can put you in trouble. So I hope you all enjoyed this first third Thursday. I'll once again share with some of the information that we have coming up that we think is helpful. If you like this, you can subscribe to our channel. You can tune in every third Thursday of the month. And I'll tell you, we're going to be going live more frequently than this. This is just the time that you will know I'll be here, right? But if we hear something financially that we want to hop on, this is something we're going to start doing regularly. Again, next Friday, 11 a.m. Central Standard Time, Black with Equity webinar. If you are someone who has equity compensation at your job, stock options, restricted stock, employee stock purchase plans, employee stock ownership plans, you definitely want to be in the building, because we're not just going to be covering information you need to know from a tax perspective, from an investment perspective, from an insurance perspective. We're also going to be talking about some of the do's and don'ts and taking your questions on how to leverage this for wealth building opportunities. I will see you guys before then, but in terms of the live, you can bet on us being here the next third Thursday of March, and I hope to see you then.